Three, two, one.
Hello, everybody. This is Michael DeJoyer, and this is today's DAS Winner's Circle and Market Analysis for the week of 1/4/2021 to 1/8/2021, the first week of January. It's a big welcome to everybody in the new year. As always, my name is Michael DeJoyer. I'm an educator and institutional sales director here at Dash Trader, and I'm joined by my co-host, Jill Melandrino, global markets reporter at Nasdaq. Jill, how are you? Welcome to the new year.
Yeah, great to be back. It was nice to have a little bit of a break, but I'm looking forward to getting back into it for 2021.
Absolutely, me too. Yeah, I'm joining you. That's why my video's not here. I'm joining you from Recife, actually Caneros, Brazil. And I got a little bit of vacation, even though the pandemic continues to rage on in New York. It's another week and another exciting week of news here in the world. There was a riot at the Capitol, and the markets don't seem to care. What are your thoughts about everything that's transpired in the last week, and how the market really pretty much failed to react except to go up?
Well, there's a couple of things here. I still can't wrap my head around it as an American citizen and our position in the world, where we've inserted ourselves into many conflicts throughout the history of our nation to preserve our ideals of democracy. So I think we have a lot of work to do there from a social perspective. And it is hard to also wrap your head around why the market continues to hit all-time highs, even with the uncertainty that we're seeing in Washington, D.C. A couple things that you can say here is, if you isolate it strictly to a stock perspective, nothing has changed, right? Nothing has changed, in terms of how the market is looking at it as a forward-looking discounting mechanism. I guess that's one way that you can rationalize it, but when you look at stocks like a Tesla, for example, that continue to add, the market cap of GM on every single day and then some, what has changed there? So, longer term, what they're doing with their technology and the fact that they have, they were the disruptors within the auto industry. And I would argue that, to value them as an auto company might not be as appropriate as valuing them as a technology or EV company. So there's a lot of confluences at work here, and while we typically say markets don't like uncertainty, that seems to be bucking the trend at this point. So I guess my best guess would be is that nothing has really changed from a market perspective, and isolating that from what we were seeing happening, socially and politically.
Yeah, I would say that once again, The Simpsons seems to be correct. I mean, it seems like the guy with the hat with the horns was also in The Simpsons. I mean, as disconcerting as it was to watch the Capitol be stormed, it's a little also surprising that the Capitol could be stormed as easily as it was. It almost seems like it was allowed to happen, but needless to say, it was a very disconcerting day yesterday, and the markets don't seem to care. The markets seem to shrug off any kind of crazy news, because I think the long-term belief of the markets is that normalcy is coming soon. Although the numbers for the coronavirus continue to be very, very negative, and the employment number today was also very, very negative. It was expected to be a positive number, and it was a negative number. But needless to say, the markets seem to be at the all-time high. I believe it's partially due to the weakness in the dollar, which brings me to my next topic of news, which is Bitcoin and Ethereum. And you and I have been smiling about Bitcoin and Ethereum pretty much the entire year, and we have good reason to continue to smile. So what are your thoughts as Bitcoin approaches 40? I mean, it basically hit 40,000 today.
It hit, hold on my Coinbase account now. So the high was 41,986. It went from 30, this is a 24-hour period, so 36,000 to 41. We're at 39 now. Still only down, 0.6%. Ethereum, on the other hand, and actually my last add to Ethereum was on December 31st, which coincidentally was the last day that's down. So now the fact it's down about 9%, I'm going to totally take advantage of that and do a little bit of adding here. And, again, what's happening in Bitcoin, Ethereum, and the digital asset space in general is typically compared to 2017. It's almost like when we talk about tech stocks being in a bubble, we compare it to 1999. My argument has always been is that things are certainly different now in terms of market structure and the types of companies that are in the tech sector now. And I would also argue that 2017 is very different than what 2020 and 2021 is for the digital asset market. It's not riding on the flow of momentum trading. You have institutional investors that are involved here who typically hold their positions longer. You have companies like MassMutual, PayPal, Square. I can't remember his name off the top of my head right now, but an NFL player negotiated his contract where I believe half of it will be cash, half of it will be Bitcoin. It's also reported that I think 2 New York NFL and Major League Baseball players are trying to negotiate a similar contract. So you're certainly seeing the mass adoption there. I also think that when you look at digital assets, particularly tokenization, and the way companies are looking for alternative forms to come public these days, that's why SPACs were a big story in 2020, direct listings were a big story in 2020. I think as we look longer term and further down the road, that these, not Bitcoin or Ethereum, but the different types, you could tokenize any asset for the most part, but from when companies go public, they're founders and the VC companies that make billions of dollars, right? But what about the employees, or what about the workers that are part of this company, whether they're contractors or not? So why not, close that wealth inequality gap by tokenizing some of these assets so employees can participate in the growth of the company as well as the growth in the equity or the digital asset, if you will. I had Jeff Dorman, who is the chief investment officer of ARCA. They are a digital asset hedge fund. And this is a conversation that we had today. And he brought up an awesome point. And this is something that I haven't covered yet on my show, but something that I'm definitely starting to build that stable up with now. But when you think about governance, when you think about wealth inequality and the, the social issues that we're dealing with right now, why couldn't digital assets be part of that ESG story? So if you have ESG managers that have that mandate to incorporate assets that fulfill those ESG guidelines, if you can use tokenization to narrow that inequality gap or allow more employees to participate in the growth of the company, that might be an interesting route as we look longer term down the road when it comes to capital formation. So, I think we're still in the very early innings of how this can be used, from the institutional side of the house.
Yeah, and I totally agree. I mean, and we're going to look at this a little bit more when we take a look at the actual GBTC chart. But I mean, people are, I've been saying that Bitcoin is going to be going to 100,000 possibly this year. And it's very easy to get from 50 or 40 to 100,000 because as it goes up, the supply is fixed on Bitcoin. And because the supply is fixed on Bitcoin and there's more and more demand, and now there's these institutional holders that are buying and holding, it makes it easier and easier for Bitcoin to really pass bigger and bigger numbers very, very quickly. Ethereum could potentially go from $2,000 to $5,000, according to my technical analysis, very, very quickly, because there's certainly a limited amount of supply. There's certainly more supply of Ethereum than there is of Bitcoin in terms of the amount of tokens that are out there. But certainly the space between where we are now and the actual market capitalization is very, very small. In fact, you just mentioned that Elon Musk is now the richest man in the world, or vying with Jeff Bezos for the richest man in the world. And that's partially due to the very, very limited amount of supply of Tesla shares and the very, very limited amount of supply of Amazon shares. And if there's a very limited supply and the demand remains consistent, and it looks like demand is increasing for digital assets, that's only going to continue to push upward pressure. And of course, that's what I think we have in store for 2021 is really the emergence of digital assets. And the staying power of digital assets. I do think we're going to have some very violent pullbacks, but potentially that's one of the things that we have to watch out for is that real staying power, that digital assets are here to stay. So on that note, I'm going to jump to the charts because I think that the beginning of the year started out with a little bit of fear and uncertainty. In the very first day of the year, we had a pretty violent sell-off. As you can see here, this first day of the year was a sell-off. Then we kind of rebounded. We put in a reversal bar, and then we kind of jumped back up to prior highs. And now we've actually exceeded those prior highs and made a shallow new high. Now, I'm not sure if that's a somewhat foreboding element, because certainly things can change very quickly in markets, and certainly January is not always indicative of the entire year. But here we can see on the S&P that we've also put in a shallow new high, but very, very quickly retraced the pullback. I mean, we made a new high very quickly after we pulled back from those highs. And it's not just on the S&P, it's not just on the Nasdaq, it's across the board. It's the DIA, the SPY, and the Nasdaq. That's all three major U.S. indexes, and the ETF tracking stock. And gold initially gapped up pretty precipitously on the kind of fear and uncertainty related to the January 6th, certification of the Electoral College votes. But then we've pulled back on gold. Probably it looks like gold maybe in a pullback and ready to reverse and go back up now based on the moving averages. But that's still somewhat uncertain. But gold has certainly made a nice run over the last few weeks. Generally, gold does do very well going into February. It's a very traditionally good time for gold going into the Chinese New Year, as well as some Indian holidays as well for people to buy gold. Also, the U.S. Christmas holiday is usually pretty good for reducing supply of gold. But here is the chart of the GBTC, which is a tracking stock for Bitcoin. Here was the huge breakout of Bitcoin. And it's kind of, I mean, to me, I'd be very, very scared to call a short-term top of Bitcoin after having made such a tremendous run. But certainly it looks like it's made a measured move to the upside and maybe ready for a pause at 40,000. 40,000, it's certainly held up pretty well, in my opinion. Ethereum, which the ETHE, which is the Ethereum tracking stock, had a split, which is why this chart shows this big drop here. But Ethereum has pulled back a little bit and might be getting ready to run next. Usually Bitcoin runs first, Ethereum runs second, and then the altcoins run third. A lot of the altcoins are Ethereum tokens. They're DeFi coins. So certainly keeping an eye on this Ethereum chart as well. Facebook, very big news with Facebook having blocked President Trump in his last 2 weeks of his presidency, or last 3 weeks of his presidency. What are your thoughts of Facebook shutting down President Trump's accounts? And will that have any ramifications with this section? Was it Section 230? I don't remember the actual the law, but tell me your thoughts, Jill, on Facebook shutting down President Trump's accounts. Is that kind of like a broadside, you don't matter anymore?
I think, personally, I think it's too little too late. And the same with the other social platforms. But I think what we're seeing here, when you think about it from a business perspective and as a nation, how we move forward and how this is going to be legislated, that social media platforms are certainly going to have to come to some kind of agreement with lawmakers, because, every period of history, there is going to be some sort of social unrest. This is not the first or the last time that we've experienced this sort of division in the U.S. It's part of our history. It's part of who we are. And that's just the way that societies are. But I think social media has certainly amplified these feelings. I think a lot of these feelings that have been under the surface now have an outlet to come to light. It is much easier to organize digitally than it is to go door to door and organize person to person. So, and I would even say, when you think about mainstream media, whether it's conservative leaning or liberal leaning, that I feel like part of this is almost a wake up call in terms of how we disseminate information. How do you make that distinction between a publisher, which is what social media platforms are, and then versus what traditional media may be. So, and you and I have spoken about this before. We use Nasdaq Zoom platform to do this weekly. Let's say I'm not here one week and then you go off on some sort of crazy tangent and you're posting, I don't know, curse words or some crazy stuff. Are we responsible for that because we were the medium, that platform to publish that, right? So if you think about it like that, there's so many questions that need to be answered, but I will tell you that it is not something that will be answered overnight. This will take years to work through, particularly, anytime you're looking at government legislation and then, the teams of lawyers that these social media companies have. But it will, when you think about it from a sociological perspective, it will be interesting to see how it plays out, because just how fractured everything is right now. It's a little bit raw to kind of come up with a more eloquent answer than that, to be honest.
I think that you said the key word, that social media, they are publishers and they are responsible for the content. They aren't just infrastructure. And I think that they have to be treated as publishers without carte blanche, no liability for what the users are creating and publishing on their platforms. And I think that that's ultimately what's going to come out of this. And I mean, I think that there was a recent update on WhatsApp of the privacy policy, and I don't think anybody read that privacy policy update. And I think that people would be, if they actually read that update, they just want to use WhatsApp, and they're not reading that privacy policy update of WhatsApp and how Facebook is using their data and how their data can be used against them or to sell them stuff. So I think that ultimately, I think the use of data is something that's going to be determined in the next 3 to 4 years.
Right, Mike, and I would agree with you, but there's a counterpoint to that as well. So people like our kids' age who are digital natives, they grew up with a phone in hand, they could care less about the data conversation. It is just part of who they are. So if we were to have this conversation, let's say 30, 40 years down the line from now, about how our data is being used, to them, it does not matter. So I think when you look at, I don't know, I don't want to put what's it called, a broad brush stroke with this, but I think a lot of it is very generational. So, and for the kids who are using WhatsApp, TikTok, Snapchat, like the more Gen Z focused platforms, they simply, it's not a blip on their radar.
Yep. No, I totally agree with you. I do have 3 small younger children from 16 to 10, and my children don't care, and they don't have any knowledge of the use of their data or privacy policy issues. But I think also that's part of our jobs as parents, is to worry about things that our kids don't care about, and don't let them get taken advantage of, because in a lot of ways, they when we were kids, Jill, we used to watch Saturday morning cartoons, and what you could market at Saturday morning cartoons was very different from what you could market during the regular viewing hours. And our parents worried about what was being marketed to us during Saturday morning cartoons. And I think that we need to worry about our kids and how they're being marketed to on YouTube, on Facebook, and on all these other platforms. So certainly I do agree with you, but at the same time, I think we need to really worry about our kids' futures and how their data is being used, even if they don't worry about it, As far as the reason I brought up these charts is that one thing seems very clear, is that the market is stagnant and sideways. Even though we recently made new highs, okay, they were shallow new highs, but the component stocks that are making those new highs, the exception, Microsoft is a little bit more bullish than Facebook. Facebook being held down by some of the antitrust issues and some of the data policy issues. Certainly Google shrugged off the data policy issue and the huge, massive lawsuits that it's facing from the US government. Apple continues to look bullish as well, in that it's making higher lows, not just higher highs. It's making equal high and then higher lows, which is also bullish. Then, we haven't had this one on here for a while, but it looks to me like oil is slowly and gradually creeping to the upside. And that's important because oil is indicative of the old analog economy. Oil is indicative of everything that moves. And if you want to move something, you need oil, whether it's a candy bar going to your local corner store, or whether it's a case of Coca-Cola, or it's a container that's being shipped from one side of the world to the other. And oil is going up in price again. And that tells me that the world is getting back to normalcy. And I think that, one of the things that we had mentioned in our newsletter is that our best pick, it's kind of a dogs of the Dow kind of play, is Exxon Mobil. Exxon Mobil put in a double bottom. It is basically the biggest of the big oil and old analog technology. It pays a very, very good dividend. And it kind of had a weekly breakout above its moving averages, which have been declining for a very, very long period of time on the weekly. And now for the first time, it's kind of broke out to the upside. So what we're looking at here is that the old economy, the analog economy, is now coming back. Okay, finally, it's not quite there yet, but it's showing signs of rebirth. And certainly oil is a big indicator of that, and Exxon Mobil being the prime mover of oil-related products, being a very, very diversified oil-related company. Any thoughts on oil and Exxon Mobil, not specifically, but generally oil and oil producers in the oil sector in general?
Well, oil is really interesting, as is a commodity complex in general. As you had mentioned when we first kicked off the call, that the low dollar is certainly attractive for commodity investors because it makes it less expensive to buy the commodity at the end of the day. I also think what happened out of OPEC, which was a really interesting meeting this week. But even that was kind of like a counterbalance. We had the Saudis looking to cut and the Russians aren't looking to cut. And this is kind of like where that catch-22 comes into play. With oil at these levels, producers can make money as compared to $20, $30. So they want to turn on the spigot and produce more, but then when they do that, there's too much supply in the system. So it's a constant balancing game of, the chicken or the egg first. So that's one thing that's there. As you mentioned, the market's a discounting mechanism. Perhaps it's looking 6 to 9 months out. When consumer demand comes back on board. But Mike, you and I talk about this every week, not consumer travel, but business travel. I think it is going to take quite some time if we even get close to the levels that we saw in early, late 2018, early 2019, not because people are afraid of COVID-19, but we have all learned how to operate virtually. Do I need to fly out to a client once a month when I can do it virtually for their portfolio update and see them once a year in person for their annual update? We learned how to operate virtually, even when it comes to IPO roadshows. I bet you it won't be that intense 2-week nuttiness like it used to be. When you can do it virtually, you can have more meetings, you can attract a wider investor base. And then you also have to think too, when we think about ESG and companies now reporting their carbon footprint and trying to get to net neutral on there, investors and value-based investors are really in tune to this. So it's not even that we're waiting on a vaccine, we're waiting on people to feel comfortable going again. Consumer travel is one thing, but when it comes to business, I don't see why companies are going. Do you know how many hundreds of thousands of millions of dollars? Like even, last year, my cost alone just for Nasdaq was $125,000. Times that by 10 people, which was, I think at least 1,000 of us were traveling at any one time. So I think now that we understand how to operate virtually, the experience is getting better and better. It's opening up wider investor bases. We are hiring in very different geographical regions than we would have rather than just New York centric. So it's going to take a long time for the airline and the oil industries to come back online until they understand this is kind of the new normal that we might be in for a few years.
Yeah, it certainly doesn't seem like the coronavirus is going away quite as fast as we had hoped, even with the vaccine, as the numbers continue to spiral out of control in places like the United Kingdom, which has totally locked down again and has shut down all air travel in and out of the United Kingdom because of the new strain. So I do think that it's going to take a long time for people to I think that there's going to be a big upswing in the next year because people are suffering from worldwide cabin fever. Mm-hmm. But after that worldwide cabin fever subsides, I think that it's going to be a little bit difficult to get companies to want to spend $120,000 a year just for you to travel around or me to travel around to do the things that we've been doing for the last year. It's lasted now. When we hit February, we will have been in this kind of coronavirus pandemic world for 1 year. believe it or not. I mean, it's only a month and a half away. So it is what it is. It's definitely the new normal. And that brings us to a slightly different topic. We have our winners from last week, and somebody who is joining us virtually right now is Mr. Enrique. Enrique is a B1 and data science specialist from Lima, Peru. Enrico is part of the Global Bolsa group, and that is Global Bolsa is very good friends of mine down in Peru, and it's a trading community. His experience, he has made investments in the medium and the long term. His preparation, he's adapted his strategy to today and has learned the Dash Trader platform. His strategy is he's very, very bullish, which means that he's generally going long, and he's medium to long term. He uses technical analysis and the 4 stages of stock price movement. Uses breakouts as well as following the trend. His mistakes was he was overly aggressive on volatile stocks. And he learned, what has he learned during the course of the competition is that in the intraday, he had to be very fast, use the 1 through 5 minute time frames, and stay focused on following the conditions of the strategy, as well as learning from the types of trading that he'd like to do and how he'd like to automate it in the future. Well, hello there, Enrique from Peru. How are you today?
Hi, how are you? Nice to meet you. Well, I happy to participate in this this event. I investor in a medium a large not terms, but in this opportunity. We have to adapt the strategy to the intraday. It was so new for me. We have to be fast, but it was a great experience. I would like to apply to the some trading algorithmic, to
algorithmic trading.
Algorithmic trading, yes, because I think we have to use the advance about computing to use in trading, because you have to be very fast and focus a lot of time in front of the monitor. I think if you apply, if you use machine learning, you can take advantage for your trade. I think that.
Well, this is actually a perfect example of that, right, Jill, is that we have a winner, one of our 3rd place winner, which is Mr. Enrique, who's talking about machine learning and artificial intelligence. And he comes from none other than Lima, Peru, which is just showing how the world is a much smaller place and how the market is actually a global market, no matter where you are in the world, that you can trade the markets. Muchas gracias, Mr. Enrique. Very good. Bravo. You did a great job. Thank you very much.
My pleasure. Nice to meet you. I am very happy. I'm very happy. Thank you.
I hope to meet you in the future, Mr. Enrique. Now let's tell us a little bit more about some of our other winners. Our 1st place winner, which is Best 513, which is Mike. And Mike is from Moreno Valley in California. He is working on his master's degree in social work. And he's part of the Bull Bears trading community. His experience is 8 months in sim trading prior to the competition. His preparation is he watched the webinars on trading psychology and on the specific rule book of the competition. He also switched from fixed hotkeys, which allowed him to be more organized and disciplined. His strategy was to follow the ABCD pattern, which is a kind of continuation pattern. He traded stocks that were gapping 2%, large and mid-cap stocks above, and then he used his fixed risk hotkeys to trade those individual stocks. His mistakes were over trading in the first week of the competition, and he went from fourth to third place, and then consistently he took trades that he should not have taken. He learned a lot about risk management, which is critical to trading, and he learned how to control his emotions by not distracting himself too much. While trading, he would often watch a movie so that he would not overtrade, which prevented him from getting out of a trade prematurely. It also helped him from getting over anxious or keeping his anxiety in check. And this is one of the things that we learned over the course of this competition is that, we watched the biggest winners were the people who lost the least, right, Jill? This competition was very different from others. It was the people who were disciplined and who stayed focused and lost the least were the people who did the best. And that's a little bit different from our other competitions, but I think that the market was a little bit more volatile and a little bit more sideways than usual. Usually we saw the markets go up and away, and I think that a lot of beginners got overconfident from that. What are your thoughts on that?
I would agree with you. And that really was the story of 2020, where we saw this influx of retail investors come into the market through a various number of platforms, which is great because it shows that investor education, stuff like what you do, Mike, is really helping the retail investor get involved, and they have tools at their disposal that we couldn't even imagine when we first got into the business. But one thing that does concern me is it's a market of stocks, and it's certain stocks that are either leading or not leading, and everyone is piling into the same thing. I'm not talking about Bitcoin, Ethereum. That's a very different story, but Tesla's a perfect example of it. And the thing is that since the pandemic started, let's call it the beginning of March, when we saw this huge influx of retail investor money, and you have the stimulus checks that were part of that, we also saw an explosion of options volume as well, which is a conversation for another time, but that's super interesting. With the exception of a few blips here or there, it's been straight from the bottom of the left to the top right of the chart. And I think since, let's call it, mid-November, maybe even early December, it's really been in that range. That's what we've been talking about. So I think it's throwing people off guard a little bit, and there certainly has been more volatility in the market for this first week of trade for 2021. So that could be why we saw risk management take more precedence than actual gains, which is a good thing. You need to be able to do both.
Absolutely. I totally agree with you. I think that usually in my experience is that when the markets get this overconfident, it's usually ripe for a fall. And, one of the things that we saw is that the markets have a tremendous amount of complacency in them right now, in my opinion. And some of the indicators, like today's jobs number, although the market did not react negatively to the jobs number, which was about 150,000 jobs were expected to be gained, and we actually had a net loss of 50,000 jobs, which is actually incredibly bearish. The market still shrugged that off. And when you start to see negative data being shrugged off as positive and not being reacted to the right way, that's usually a good sign. It's indicative of an overconfident market. And with this amount of novices in the market, this amount of new traders in the market, usually, and I'm not saying all the time, but certainly usually, this is indicative of possibly a correction in the near term. And I would really caution anybody who's just recently started trading who thinks that stocks only go up. I see a lot of posts on the internet saying stocks only go up, buy the pullback, buy the dip. And yes, that has absolutely been working for the entirety of 2021. But there is another old expression that goes back to 1998, 1999, which is, stocks are also sometimes loans from the market, meaning that you can get a loan from the market until the market takes its money back with interest. And that's usually when the market goes down. And I remember from the tech bubble, which is that when the market decides to turn, it turns fast and furious. And you don't want to be caught in that turn thinking that stocks only go up, because all your paper gains can turn into big losses very, very quickly. So I give a word of caution to everybody that we're at a point of a very, very mature market, and you should be careful, and you should not be investing in money investing with money that you can't afford to lose. And there's a tremendous amount of novice traders in the markets. And to me, I caution anybody that the markets can bite both ways. They can give you some money and you can feel rich for a period of time, and then you can certainly lose it very quickly if it does turn on you and you're not in the right direction, or you think that it can only go up. So nothing is ever certain in the market. That's one thing that is for sure. Any thoughts on that, Jill? I mean, any comments?
Yeah, I definitely have a few thoughts on that. It's also like the other adage, take the stairs up, elevator down, right? Yep. But, and I alluded to this in the beginning, I think this is very different than 98, 99. There are some similarities, but there are some very big differences as well. I think some of the types of companies that are leading the way are very different than what we saw in 98, 99. Market structure, of course, is very different. But as a retail investor, the educational tools that are available to you now we've never had them. That as professionals, we didn't have them in 90, 2000. Like what Mike is teaching you guys day in and day out, that did not exist. So we have a number of trader services such as that. The exchanges, Nasdaq, we have a smart investing hub. We team up with all of the, let's say, Robinhood platforms, if you will. And our mission has been, since it kind of always has been this way, but as an exchange leader, we do have a commitment and a responsibility to the investing public. We have put together more educational programs than I can ever recall at any point in my career. And that is a good thing, that these tools are available. The industry is respectful and cognizant of their responsibility for investor education. So it's there. And if you don't do your homework, it's a big disservice to you. So take advantage of those tools, whether it's available on your individual brokerage platform, on which almost all of them have these kinds of tools now on the retail level. But there's no excuse not to have access to investor education. Just take advantage of that as much as you can.
I totally agree. Education is the most prudent way to approach the markets. And certainly if anybody's interested in getting educated, they can certainly contact me or DM Das for some information about working with me and getting an education. But I would like to congratulate all the winners at this point. Stay informed about future number one best trader competitions and follow us on social media at number one best trader, at Twitter, one best trader, Facebook, one best trader, Instagram. We have not been shut down like the president. We are totally active on all the social media channels. And I want to give a big thanks to Mr. Enrique. Enrique, any final words to anybody out there about education, about what you learned?
Thank you for. It was great for me. No, I think another people can participate in this competition. Is a lot of adrenaline, no?
Adrenaline, lots of adrenaline.
Adrenaline, because you have to make trades intraday. Is a new experience for me, no? I'm very happy and nice to meet you. Thank you.
Muchas gracias por todo. Thank you so much, Mr. Enrique. Thank you so much. And anybody else who'd like to hear about future updates, today we released our first of our 4-part option series done by me, Michael DeGioia, option series on YouTube from Das Trader. So if you're interested in learning about options, you can check out our first options video on YouTube. Stay up to date with all things Das by signing up for our monthly newsletters. And fill out the form at the bottom of our webpage. That's at www.dastrader.com. Subscribe to our YouTube channel at Das Trader TV for market analysis reminders. And you can follow us on all of our various Das Trader social media links. Thank you very much, Mr. Enrique, for joining us. Thank you, Jill. It's always great seeing you here at the end of the week. Enjoy your weekend. Thank you, everybody, for joining us here. And have a wonderful weekend, everybody. Goodbye. Bye-bye now.
You too.
Ciao.
Goodbye. Thank you.